think, act, and prosper. You are now tuned into the Money Level Show.
Hey Justin, how you doing today?
Doing really well, Daryl. How about yourself?
Doing good, doing good. I always enjoy our offline chats. So we just catch up on life.
Indeed, yeah.
Yes, indeed. Yes, indeed. Uranium. Let's jump into uranium. We had a big scare off. I think we obviously rose above $100 per pound, and we saw that that price has retreated. The equities retreated, and for me, it's one of these things where like I'm still holding my conviction. I still have my conviction on why the actual price is still moving the way it is. But you're gonna have these pullbacks in the intermediate term, and so I just wanted to get your perspective on what we're seeing there. I mean, some people may feel like it should go up in a straight line, but what are you seeing there?
Yeah, I think the most recent pullback is just kind of one of many over the years on an overall very long-term trend. We've got a very, very long-term bull market that we're right in the middle of right now. The commodity bottomed in 2016. It is up what, 5 or 6 fold since that bottom, about five-fold actually at this point. And we're going to see just an overall series of higher highs and higher lows in the commodity and in the equities. And just if you zoom out, that's exactly what's been happening. We obviously had a larger pullback and consolidation going back, 2022 into early 2023. And this next leg up, a lot of these stocks, the ETFs in particular, have these gigantic cup and handle patterns. And we've yet to break out of that handle, but we're very close to doing that before we get some multi-year sort of blue sky. A lot of the individual stocks are making all-time highs, if not, 52-week highs currently right now, especially some of the large cap liquid stocks. But yeah, we focus on the physical market and the overall fundamentals of the sector as far as we can tell. Nothing has really changed for the long term. The fundamentals look fantastic. Demand is growing a lot. That's the biggest development over the last 12 to 18 months, I would say, is demand growth. Demand growth continues to impress. So not only have we been in a supply constrained environment for quite some time, supply is starting to respond a little bit here, but now we're seeing demand grow even faster than we had imagined just a couple of years back. So we're looking at 4 to 5%, possibly higher compound annual growth rate for the demand of uranium based on the growth of nuclear energy. Almost on a daily basis, we're seeing some news story about life extensions. Just today, an article saying the 3 reactors operating in New Jersey, they want to life extend. And just last week, the South Koreans are saying that they want to life extend 10 of their reactors that were set to shut down by 2030. So in the next 5 years, they had 10 reactors that were set to be decommissioned, and they're saying they want to life extend all of them. So these things just continue to stack up on the demand side. Supply side has its problems. Like I said, we're seeing the gears turn. We're starting to see a little bit of supply come from brownfield restarts primarily. Greenfield has yet to be seen. And I think we have years away before we see meaningful greenfield new mines being built and producing uranium sold into the market. So as far as I can tell, it's onward and upward for the commodity and for the equities as well. So yeah, we had a decent little pullback there. The price rose so quickly and so violently. It went from in the 50s to over $100 a pound in about 5 months. And the equities and the industry, investors and the industry all just kind of went, okay, let's take a breather here, see where this settles out. Seems like it's settled out. So we're already seeing the spot price start to move up. We're seeing the term market really heat up, and the equities are up decently, especially this week. It's been a very, very strong week for the sector.
Mm-hmm. So when you say the term market is really heating up, what are you seeing there? Time out. Quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
So we're starting to see some deals be signed. It's picking up a little bit. There's not a lot of volume signed year to date. It's about 23 million pounds on an annual basis so far year to date. That's a much slower start than last year, but last year got kicked off with some very large contracts between Cameco and Energoatom in the Ukraine. So that was kind of that started off the year. But what we're seeing is a lot of activity kind of in the background. So conversations being had between producers or to-be producers and utilities, and a lot of tenders in the market, RFPs, trying to secure pounds for the long term. We're seeing these contracts that are under discussion go out much further into the future. So, mid 2030s and later. And we're also seeing the volumes increase. It's a very, very active term market. And my biggest takeaway from that observation is that the industry is accepting this present pricing environment and they're acting accordingly. So they're saying, okay, this is what we're looking at here. We need to contract. We're not expecting the price to fall substantially. So we're going to go ahead and step into the market and buy what we need to buy. That's a very, very good sign. Anytime you see a big price move like that, it has to settle back out a little bit and have some sort of acceptance of the present pricing reality. And that's where I think we're at now. So after a large price rise, like we've just seen, the industry has to see where the price settles out. When the demand pulls back, and we had a back late February, early March, the spot market was just absolutely dead. There was nothing happening. In fact, the price drop that we saw was on a very, very small amount of pounds being offered by a couple of traders. So once the price pulled back a decent amount, it pulled back from 106 to 84. That's a decent pullback. The equities actually pulled back less. The equities are outperforming the metal this year so far year to date, which is very nice to see. But what the industry is doing now is essentially accepting the present pricing environment and securing the pounds that they need to secure going forward. That is a very good sign. That shows you two things. One, they don't believe the price is going to drop significantly from here. And two, there aren't substantial enough inventories to ride this out much longer. If you have enough inventory, you can sort of step back during volatile times in the market and see if there's a chance that that spike was just kind of a one-off, right? And the fact that it wasn't driven by the financial players was also another signal to the industry that we're not just going to let this, it's not going to settle back down to $60 a pound. It's just not going to happen. So now that we're back at 90 bucks a pound in the spot market, the term market activity is very active. We expect to see a lot of pounds being actually inked and reported in the long-term price reporting that happens once a month at the end of the month. But that long-term price is continuing to rise. The 3-year forward, 5-year forward prices are very strong. Everything's still really tight in enrichment and conversion across the board. The demand is just growing so much that there's price pressure across the fuel cycle.
Mm-hmm. Gotcha. So whenever it seems like what I've noticed in like any asset, when you have big players that are wanting to spend big money, they usually don't buy when things are just hyperbolic. Unless they're just forced to, and it seems like these big players waited until the pullback in uranium, and then now you're seeing more action in the term market to where they're trying to secure while the price corrected. Is that a fair assessment?
Yeah, I think that, and you can say the same thing about the investment environment as well, and speculation coming from larger institutional interests in the sector. The sector pulled back about 15 to 20% roughly, and now we're seeing big volumes come in. URA just reported this morning that 2 days ago or 3 days ago, depending on the delay. Sometimes that's not really that clear, but they issued an additional million shares in URA, million shares. That's $30 million. It's more than that. Yeah, huge, huge. So big inflows into the ETFs. That usually means because they're so liquid, we're seeing some more institutional positioning coming in, taking advantage of that. Same thing goes, like you said, for utilities. Utilities are not necessarily going to be chasing prices higher all the time. The price is going to move in these fits and starts. And because the volumes are so low in the spot market, there's going to be extra volatility to the upside and the downside, unless and until there's significantly more liquidity in the spot market. It's just going to stay very, very volatile.
Yeah, that makes sense. Total sense. So I was doing some Google searching, and I was just trying to find the latest news on uranium. And I saw a lot of articles. There's a lot of articles and recent and about uranium mining picking up. There's multiple different projects in the United States. I saw an article about mining starting back up in Australia, and that could provide about 9,000 jobs. What are you seeing there? Are you seeing some significant changes there?
Yeah, like I said, so supply is starting to respond. So we're seeing a number of projects, primarily, again, brownfield restarts that are getting into productions. Encore Energy is getting into production in the United States from two different mines in South Texas. Boss Energy is starting to produce from Honeymoon. Paladin successfully restarted the Langer Heinrich mine in Namibia. Um, Olympic Dam, operated by BHP, is a absolutely gigantic mine, and they produce somewhere around 8 to 10 million pounds a year of uranium. That's basically like a bonus from their gold and copper production. They're not focused on uranium whatsoever. But to the extent that gold and copper are going to continue to rise in price, we're probably going to see a little bit more uranium out of that mine. Cameco's announced that they're going to not only increase their production coming from McArthur River, up to from 18 million pounds to 24, 25 million pounds a year. It's going to take a few years to accomplish and a decent amount of capex they're going to have to put into that, but that'll get there eventually. And they're going to invest in extending Cigar Lake to the second phase of that mine, which is going to cost Cameco on an individual basis almost $300 million. And Orano, of course, is going to have to take a share in that as well. But that expansion also going to take some time, going to cost a little money. But all signs are pointing to the industry overall universally understanding this demand environment and the fact that prices are rising. Cameco is not going to spend that money to increase production at McArthur and extend Cigar if they don't have a contract book to deliver into, or if they don't have confidence in the demand going forward for that production to be able to go into a long-term contract book. So all the signs are there. And then, of course, you just have things like the COP conference back in November, where 24 countries signed a pledge to triple nuclear energy. You continue to see more and more of this. The Department of Energy in the United States just put out a follow-up document to the liftoff report that was from 2022, where they showed that 80 something percent of the existing and retired coal power plant sites in the United States could be replaced with small modular reactors. So they kind of doubled down on that, discussed the incredible job creation that could have from that transition. So policy, government policy, in multiple countries in the West and of course in the East are more and more turning towards nuclear. So the tide is definitely coming in here. The trend is very clear, and that demand picture is getting better almost seemingly by the day.
Hmm. Yeah, that's amazing. That's exciting. So, so this is a lot different. Like I've been, just from studying the last previous cycles in uranium, this is a lot different in terms of this seems like more of a regime change versus just a supply shock. Obviously, there's a lack of supply, but there's also this incentive to you know, transition to clean energy. I mean, you have all new technology coming out, small modular reactors. You have climate goals and all of those different things. So it's kind of interesting because usually high prices cure high prices. That's always said. And so if we were to take just that specific philosophy or ideal and apply that to uranium, then it seems like okay, when the price gets high enough, it's going to correct, and who knows how high the price can go. However, like you have this other competing dynamic of where they're trying to secure uranium for the long term. They're trying to build more infrastructure for uranium. They're wanting to put more energy usage with uranium and reactors and so I'm just kind of trying to work that in my head of like okay, does that mean a sustained higher price for a longer term?
I believe that it does. Yeah. I mean, with that said, we will see a point at which supply will be able to respond sufficiently with a certain price. It's hard to say what that price is because you could argue that the incentive price for mine supply out of the ground for even the marginal projects in the world is not much higher than where we're at right now. I mean, it's probably in the low $100 a pound, really, for pretty much every project in the world to be at least mildly profitable. So, of course, it takes years and years and years and years to develop a uranium mine to start producing. That's the interesting thing with this sector is it's not like oil and gas that can pretty immediately respond in supply to a rising price. This commodity cannot, and that's one of the reasons why it swings so wildly. But there's a lot of other dynamics to this commodity that make it unique. One is that it's the only thing that can be utilized to power the world's reactor fleet. CANDU reactors, which are heavy water reactors, technically can run off of thorium with a little bit of HALEU or a little bit of plutonium. They're looking into that. That's about 10% of the world's fleet. But even if that innovation comes along, comes to pass, we're not going to see all of the heavy water reactors start to operate on thorium. It's going to take some time, but that is there. Because it's irreplaceable, the world's fleet has to buy this commodity. And it is a very small percentage of the overall operating cost of a reactor. They take a very long time to build. They cost multiple billions of dollars to build. And the price of uranium is 4 or 5% of the overall operating budget of the plant. So all things being equal, if the price doubles and triples, it will not necessarily be an impediment to the operation of that facility. You have to buy uranium. You can't not have the fuel for a multi-billion-dollar strategic asset that is crucial to the stability of an electricity grid. That's not an option. So it doesn't matter if it's $100. It doesn't matter if it's $200. Do the utilities enjoy paying more? No, of course they don't. It affects their bottom line. In some cases, utilities cannot so easily just pass on that increased cost to the ratepayers, depending on the market that they're in. In most cases, they can, but sometimes they can't. That gets a little bit difficult for those utilities. But generally speaking, the rising cost of the fuel means that you pass on that cost to the ratepayer. So if you can't not fuel your reactor, you're going to pay what it costs. That means there really isn't a limit to where the price could go. Okay, are they going to pay $5,000 a pound? No, they're not. You're going to see reactors shut, okay, at that price. We're not going to see that pricing environment, right? We're going to get up and probably north of 200, possibly even higher. If it stays there for a long time, we're going to see all of the projects do what they can to get into production. That'll take years, but it'll happen. And we're also probably going to see some innovation in other areas, like seawater extraction, potentially increased extraction coming from phosphates. So that's going to come. but it's going to take some time. That's probably the next decade. And between now and then, we're going to see a lot of pressure under the price. The other element I think that not many people are thinking about is the strategic nature of having nuclear power plants for sovereign nations. And that is that these assets are always on, they're highly, highly efficient. The capacity factor is usually north of 90%. They operate pretty much 24/7 as baseload. It's clean energy. And importantly, you can store years and years of fuel in a small warehouse. So you can run the uranium through the fuel cycle, get that fabricated fuel in a warehouse on site for the reactor, and you can have energy security for a very, very long time. Whereas for a coal plant or a gas plant, whatever it might be, you have to import material, import that fuel constantly. Or if you look at solar and wind, the theoretical lifespan of a field of solar panels is 20 to 30 years, but we're seeing them getting trashed by weather events after a couple of years of being in operation. Wind power has gone through a lot of fits and starts and challenges over the past couple of years in various jurisdictions, where it's just extraordinarily expensive. The turbines are failing. If you want baseload and you want energy security and you want years of operation from a tiny amount of fuel being stored, nuclear is the only answer. So sovereign nations that are currently relying on nuclear power are going to make sure that they have the fuel for those reactors. And that could look like buying coming from governments that nobody is pricing in. Let's just say that.
Mm-hmm. Yeah, yeah, that makes total sense. Um, so there was a lot of talk about the banning of Russian uranium. Is that still in the conversation? Like, where are we at with that? Is that something that's still in the cards?
Yeah, not only is it in the cards, I think it's going to happen. Um, so you have the legislation specifically to ban Russian uranium that passed the House back in November. It's been held up in the Senate since then. What has happened since then is that the Department of Energy has embraced this narrative, and there's $2.7 billion in funding to support the domestic nuclear fuel cycle through various forms if a Russian uranium ban is enacted. So this funding is contingent on Russian uranium being banned, and that has the support of the Department of Energy. So you have DOE support, you have this funding, you have the Nuclear Energy Institute, the NEI support. They supported it back in Q4 last year. And what that all means essentially is that the utilities, generally speaking, are on board with this. There's a handful of utilities that are not. There's some utilities that will be in a tight spot if they all of a sudden can't get that material. But the larger utilities that have more influence on policy have covered their needs in the short term sufficient to where if this material is banned, they're not going to see interruptions to their operations. So that's our estimation. We think that this is going to pass, whether it's that original legislation, whether banning of Russian material is squeezed into a different piece of legislation, or none of the above, and we see a president's executive order. All of these things are possible, but all of the signs are pointing to that it is probably going to happen. And the utilities are acting as if it's going to, based on their activities in the market.
Okay, okay. And what would that entail? Like, if our supply isn't fully online yet, it's taking years to get the mines and everything. If that ban were to be in place, what does that do to? Does that affect price at all, or do we just get it from some other nation or company? How does that look?
The problem that will be for a few utilities is that there's legacy contracts signed with Russia. They're expecting those deliveries in the coming, 1, 2, 3 years. A lot of material has been pulled forward on these legacy contracts to accelerate the deliveries in the past 18 months, and which is why mostly the utilities are decently covered. What that would mean, my estimation, if this passes, however it passes, is that we will see a reaction in the physical market. We'll probably see a reaction in the uranium market. We'll see a reaction in the enrichment and the EUP markets. I don't think it's going to be a huge reaction in the physical market, but ironically, we'll probably see more of a reaction on Wall Street. And if these stocks get bid up, that's going to lead to further reaction in the spot market. So it'll have a short to mid-term positive effect overall on the pricing in my estimation. Long term, basically, well, really what it means is it's more enrichment globally, right? Russia's enrichment capacity is not going away because the US cuts it off. They're just going to be able to sell that material to India and sell it to China, and to whoever else wants to buy from Russia, which, in the West are like, oh, who would do that? But it's a big world, and there's a lot of countries that don't agree with the views of the West and continue to do business as usual with Russia. So Russia will continue to have that capacity. They have a very large export program. There's 18 reactors under construction by Russia in other countries currently. And this export business includes the fueling of the reactors for their lifespan. And Russia doesn't have a lot of uranium. They have a lot of enrichment conversion, but a lot of that capacity is going to have to be filling these exports. So what that means is if the West builds new enrichment, and they are, Urenco is building a little bit of extra capacity at the New Mexico facility in the United States. Orano just last week announced that they were looking into potentially building enrichment in the US. And if there's further enrichment, like GLE, Global Laser Enrichment, setting up their test facility right now, they will still shooting to have a commercial facility in Kentucky that will be re-enriching depleted tails material to the tune of 5 million pounds of uranium equivalent per year. That enrichment, if that is brought online, then we'll have that capacity. So long term, it's more enrichment capacity. But the fact is, we're looking at incredible demand growth in the sector that we need it. We need more enrichment. We need more conversion. We need all of the above. So in a general commodities investment, you don't usually applaud new supply. But we're in such an environment that the demand growth is so strong that we're going to need that supply simply to allow the sector to grow. And we want the sector to grow for reasons that have nothing to do with my investment interests. We want to be able to see more nuclear power enacted in the world, and we need the fuel cycle to grow in order to allow for that to happen. So short term to midterm, it's going to have a disruptive effect in the physical market. Any type of let's say any type of inhibiting factors of the free flow of goods and services globally for this market has an effect on the price and makes it more difficult for utilities to secure what they need. So we're likely to see a reaction both in Wall Street and the physical market. I'm not saying it's going to be a moonshot. I don't think it will be, but it'll be something.
That's good. That's good. Well, Justin, thank you for the update. And I just want to give you an opportunity to just share, I mean, how your subscribers are doing. I mean, I know like in one of our previous interviews when we had that blow off top with the retail spike in uranium, and you had some subscribers that were upset. They lost money and they sold at the lows and everything. And then now we're at, highs again. Right. And so, could you just share just how Uranium Insider provides value to people? I've seen some ignorant comments on on Twitter. Oh, Justin's just trying to keep subscribers and whatever. And I'm like, Justin, actually, you provide a lot of value. You provide a lot of value, even just this conversation with just how much in-depth research and knowledge that you provide to people. And you're doing this on my platform. I'm not charging people for this, right? They may have to watch a 30-second ad or something, but, but they're getting this information for free. So you provide value. And I just want to give you an opportunity to share how Uranium Insider provides value to its subscribers.
Sure. Yeah. Thanks for that, Daryl. I probably shared with you previously, what you're reminding me of is a story about a member who had joined us. Let's see, this was January of 2022. And so we just had the big run, October, November, December 2021. He had joined in January. He had entered into tranches into his positions, which is what we always recommend. He was up pretty decently by the time we got to kind of March-ish. Then the sector kept running, and he decided to put a lot more money into the sector as the sector was kind of starting to top out, at least for that particular intra-cycle kind of peak. After which it dropped pretty significantly from April 2022 till about June or July. That was when the Sprott Physical Uranium Trust came online. Actually, that was 2021. My apologies. But we did have the drop after that. So that run, when he sent us an email and basically said, I can't take this anymore. This has been the most difficult experience of my entire life. I'm out. I sold at a loss. I lost this much money. Um, and I'll never forget this guy, because that capitulation that he had was within about 2 weeks of the bottom, and it turned around, and within about 6 weeks he would have been back in the green, or back in the black. So he that type of sentiment has been over and over thematic for this investment. You will see euphoria at the intercycle tops, and you'll see despondency at the intercycle bottoms. And it just happens over and over and over. As far as me just trying to keep subscribers, I mean, it's a value proposition, and it's a voluntary transaction. So we don't ever force anybody to do anything. And I'll tell you, we have members right now that have been with me since the beginning, since August of 2019. They're still paying members. Um, as far as membership businesses go, our retention rate is extremely high. Almost 90% of our members renew on a quarterly or annual basis. That is huge. So to me, that tells me that we're doing something right. And I don't really need to defend it any more than that. People are voluntarily continuing to stay on with us, and I'm very, very proud of that. So, but more than anything, what people receive with our service is just an ongoing communication with us about what is actually happening in this market. It can be very difficult. It can be very convoluted. There's a lot of information swirling all the time. But our members know that we've done the research, we've done the work, we continue to do the work. We have our own modeling, supply and demand modeling, that bolsters our thesis. We follow the machinations of the physical market on a daily basis. And our members are going to be the first to know whenever there's anything that is happening, positive or negative. So while we have a focus list portfolio that's gained 444% since August of 2019, compare that to URA, including dividends, is 247%. So we've almost doubled the returns of the benchmark. We're super proud of that. I would argue that our primary benefit to members is that they get their hand held through this process of investing in this very, very volatile sector. And they have a dedicated team that watches the physical market on a daily basis. So that's the primary benefit. Of course, they get a monthly newsletter, they get daily communications, they get monthly webinars, et cetera, and our focus list position recommendations. So that's the whole soup to nuts package for Uranium Insider. But yeah, it's been a great experience. Of course, it is a business, but it's a voluntary transaction, and we have a incredibly high retention rate. So that speaks for itself.
Yeah, that's amazing. I mean, 'cause just off camera, we were talking about the concept of mastery, and I highlighted that, hey, you've mastered like understanding these uranium markets. There may be there's obviously things that you can still learn and ways that you can still grow, but just how much time and energy that you've placed into this like has helped you become a master in understanding the uranium market and many things like that. So first of all, like, people are paying for a service of people who have mastered this, right? So that's like one thing. Second thing is people are buying back their time, because you all have put in the I don't know how many hours a week you put into research and such, and then you're condensing it to a webinar, or you're condensing it to a newsletter and such, and then you're even giving the what your portfolio looks like and such. And so like people are able to buy back their time, because you did the upfront work. And so that's that's just a lot of value, and I think people should understand that. And so I thank you for coming on, and always appreciate the time that you give to the audience.
Yeah, thanks a lot for that, Daryl. I completely agree with you. I appreciate you saying that.
All right, till next time.
Cheers.